Hello, my name is Anthony Saccaro, founder and president of Providence Financial and Insurance Services, located right in the heart of the San Fernando Valley in Woodland Hills, California. And I'm also host of the Providence Financial Retirement Show, which airs every Saturday on KRLA AM 870, The Answer. And the purpose of this video is to provide a quick market update to my clients. And if you're a client of mine, thank you for your trust, thank you for your business. And really, my goal is just to let you know what I'm thinking, let you know what the market's doing, and really just give you a quick update. And we're going to post this on our Facebook site, and of course, it will be posted on YouTube as well. Now, if you're not a client of ours and you just stumbled upon this video, if you want to get more information about us, feel free to go to our website, providencefinancialradio.com. You can get all the information about us that you want. Or call me. I'd be more than happy to answer any questions about this video or any other financial questions that you have. And, of course, all that information is available on our website, along with my past radio shows, so you can listen to that as well. So, there's really two parts I want to talk about in this economic update. The first thing I want to talk about is where the stock market is. And the second thing I want to talk about is some of the market numbers that came out, some of the reporting numbers, the manufacturer reporting numbers, the employment reporting numbers, some of the ISM reports. So I want to talk about that as well, too. So if we start talking about the market, we've had another volatile week just like the whole year. Nothing different. We've had the worst start to a year in history. Market's down 6.5%, and we're only 30 days into the year at this point, or 34 days, however many days that is, since this is February 4th, 2016. And you get the sense that the market is being stretched and then released, and then stretched and then released, kind of like a rubber band. The market goes down, and everyone's feeling a lot of tension, and then it comes back, and then it goes down again, and then it comes back. And the problem is you can only stretch a rubber band so many times before it winds up breaking. And the same thing is true with the economy. You know, it used to be that a 100-point decline in the economy was bad, or a 100-point decline in the Dow Jones, the market, was bad. Headline news. When nowadays, you almost have to have a 500-point drop in the economy for it to even get talked about. Very common to have a couple 100-point swing in a day. Matter of fact, today there was over a 200-point swing in the market, and yesterday there was over a 400-point swing in the market from top to bottom. So it just doesn't get talked about. But eventually that rubber band's going to break, and eventually the market's going to break. And my fear is that if you're not positioned properly, then could be a problem. Could be a problem. You could lose a lot of money. You may not be able to afford to retire and so on. Now, the good news is if you're a client of mine, we know this. We have you positioned in the situation. When the market goes down like it did the first couple of weeks of January, the kind of phone calls we get are the phone calls saying, thank you for taking us out of the market. So those are good phone calls to get. But unfortunately, all of the economic data that recently came in from the ISM hasn't led us to any different change of thought. The reality is the numbers were down, and really I think when you look at all the numbers, it just verifies the economy is slowing. And if the economy is slowing, then what's going to happen to the stock market? The stock market's going to stay where it is, or I think even have some more declines in it. So I want to talk about the ISM numbers very quickly, and I don't want to turn this into a 1-hour monologue and get it into a boring what's the ISM. That's not my goal, but let me give you just a brief idea. The ISM is the Institute of Supply Management, and what they are is they're a company that measures different things about what's going on in the economy. They measure employment, they measure manufacturing, they measure business output. Really, they measure different things in the economy, and so they can come back and give us a report and say, how is the economy doing? And the way that they measure this stuff is by surveying different groups of people. They survey employees, they survey employers, they survey companies, manufacturers. And so the responses that they get are, very key into the reports that they're going to give us, the data that they're going to give us. But ultimately what they do is they provide indexes of certain things, indexes. And so if those indexes are going up, then it looks like we're doing good. If the indexes are going down, then it looks like we're retracting a little bit or contracting a little bit. And generally speaking, 50 is the average. The number 50 is the average. If the index is above 50, measures above 50, well, that generally represents expansion. And if the number is below 50, then that generally represents contraction. So the good news is, while all of the numbers that came out are above 50, the bad news is they're all down from where they were in December. And this is something that's generally measured month to month, so you can kind of see where we are. So let me just read through my notes here and give you some of the exact numbers. The non-manufacturing index, so this would be an index of services that are out there. Well, in December, that number was 55.8, but in January, that number was 53.5, so that's a decline of 4.1%. Business activity in December was 59.5, but in January, it dropped a lot. It was 53.9. That's a decline of 9.4%. Employment activity declined, went from 56.3 in December to 52.1 in January. That's a decline of 7.5%. New orders index went from 58.9 in December to 56.5 in January. That's a decline of 4.1%. Prices paid index went down from 51 down to 46.5, a decline of 8.8%. So it actually went from expansion into contraction territory. And so really, all of these numbers are down. And while most of them are above the number of 50, the fact is they've all come down. What's that mean? It just means that the economy is continuing to slow, and that's not anything new. The last quarter of 2015, a lot of the big players, meaning big companies, Fortune 500 companies, came out and said that their profits are slowing, their revenues are slowing, and they see that for the next couple of years. So this is just confirming that everything seems to be slowing. Whether we're going to go officially from expansion into contraction, I don't know. What I do know is that everything is slowing, and that's part of what's caused the stock market, although really I think the bigger part of the stock market right now hasn't even caught up to that yet. I think the bigger part of the stock market right now is oil. Oil is still stubbornly low, and I spent some time talking about oil last week, so I'm not going to recap that. If you want to see that, you can go back and watch last week's market update, which is available right here on YouTube as well. So the bottom line is that everything seems to be going down. I believe the market's going to continue going down as well. Now, it doesn't mean it's going to go down next week or next month. You know, the market tends to fall more like a feather falling out of a plane than it does like a rock in the ocean. You know, a rock's just going to go straight down, but a feather's going to float down a little bit and then catch an updraft, and then maybe float down a little bit and catch an updraft. But eventually that feather's going to get to the bottom. And I think that's where we are. And the market generally declines over a period of a couple of years. So I'm not saying that next week the market's going to be at the bottom or the next month. But I think over time we're headed in that downward descent, kind of like a plane coming in for a landing at some point. So what do you do? Well, if you're a client of mine, the good news is you're already protected. You know this, we know this, so you're protected. If you're not a client of mine, then I think there's a couple things to look at. Right now is really not a good time to be in the market. You know, market's at all-time highs, minus the 12% or so that we're down from the all-time highs. But essentially, we're still at record levels in the market. And the old stock market adage is buy low and sell when. Well, you want to sell high. So you don't want to buy high. I think it's just a bad time to buy. And it doesn't really matter what age you are. I think it's just a bad time to get in the market. So if you have to own stocks, though, if you're just not going to get out of the market, then you want to get stocks with dividends. So at least when the market crashes and recovers, at least you've got some dividends in there that you're going to wind up, being able to get that income. However, what a lot of my clients are doing, especially my younger clients, are treading water. They've got investments that are designed to pay them 4 to 7% rate of return, but without the risk of the market. And that's our goal for our clients. And for our younger clients, treading water, see what happens in the next year or two, earn 4, 5, 6, 7% along the way, and then at some point they can get back into the market. For our older clients, though, clients that are above the age of 50, well, at some point in time, if you've won the game of life, if you have enough money to be able to live off of your interest, then you don't even need the market. And Wall Street doesn't want you to know that. Wall Street wants you to think that you got to have money in the stock market, and it's taboo if you don't. But that's just not true. If you're over 50 and you have a sizable portfolio and you can live on your interest to supplement your income, then really there's no reason for you to gamble at all. So the good news is for our clients, you're already in that position. Again, thank you for your trust. Thank you for your business. If you have any questions about this video, again, don't hesitate to look us up. Providence Financial Radio is our website, or you can call us here at the office, 818-887-6443. I'd love your feedback, and thank you for watching.